This video introduces the EMA Ribbon Master Strategy, and I'm really pleased to introduce this to the trading community, especially the Daily Edge Trading Group members, because it combines some code and framework that I had developed that I never released to the public, and I'm really pleased with the way that it's actually working out with the new additions. The EMA ribbon strategy, the master strategy, builds on the existing EMA strategy that was already released that members are already familiar with. It's a robust, fast trading system. It combines multiple time frame aspects built everywhere into the strategy. It combines swing, scalp, greedy, and volatile trading styles depending on the current market conditions. It works on intraday timeframes as well as daily and weekly timeframes. Trade sizing, targets, and stops are shown as new trades form and existing trades develop. That was one of the major introductions to this strategy. There was no stop, trailing stop. The targets were shown, but there, and I'll get more into that in later in this video. But specifically, the stop calculated, that was never really shown along the way so that you could actually adjust your trade stop. Alerts were added, many alerts to warn anyone that's using this strategy on all aspects of the trade evolution. Alerts are ready to be used for the complete life cycle of automated trading also. So this strategy is completely automated ready for use on something like alertatron.com for exporting the actual alerts from TradingView into an exchange. Most people that are doing this kind of stuff are using crypto exchanges, but there's other avenues for doing Forex and for equity futures also. So it's automated ready to use the alerts to dictate the evolution of a trade on another exchange platform. So all that is built into this strategy. So the EMA ribbon strategy just combines two fast EMAs, and that's what's shown in blue, and white is a fast and a slow EMA ribbon, and it's always on a higher time frame. And in this case, for this chart, this is what I have in the background is S&P 500 futures for the December contract this year, and this is on a 1-minute chart. This EMA ribbon is showing the EMAs for a 15-minute time frame. And everything that I've included now that updates it, there's no longer the jagged kind of look that was before. This is updated in real time, and the current endpoints of both EMAs are projected into the future on the next time frame interval that is specific to these EMAs. So what does that mean? I mean, that sounded complicated, but it's not that complicated. The EMA ribbon shown is a 15-minute EMA ribbon. So the last minute because this is a 1-minute chart up here, the last minute is currently 1844, 6:44 p.m. Eastern Time, and that's where these two EMAs are pointing to. The last minute in that interval, in that 15-minute interval. So as soon as this interval is over, these will update and point to the next ending of a 15-minute interval, which is at 1859 or 6:59 p.m. Eastern Time. So it's showing you where the current projected endpoint is based on the current price of where these EMAs are going to end. So this is the same price that you would get as if you were actually viewing these EMAs, these exponential moving averages, on a 15-minute chart. So that's a nice addition, and smoothed out the actual EMAs so that we can actually view these things on a lower time frame chart, but we're viewing a 15-minute EMA ribbon. So all of the trade conditions are met on a lower time frame, and in this case, a 1-minute time frame. So we're looking for specific trade parameters, And in the case of a positive looking ribbon, which is in blue, we're looking for longs. In the case of a negative ribbon, which is in white in this case, and these can be changed, these colors can be changed to whatever preference you have, we're looking for shorts. So that's the basic premise. And why does this work? With the EMA settings how they are, the fast and the slow EMAs here that are in blue and white, they're very, quote, fast. I'm making quotation marks with my fingers. And since they're so fast, it's very difficult to form a trade by back testing the EMA ribbon and then forming a trade to go back in the direction of the current EMA ribbon. So if we look back here earlier in the session today, today was Wednesday, October 21st. This was an example of a long. The ribbon flipped to positive, which is what these two little dots are right here. These two little dots designate that at 8:29 a.m. Eastern Time. Remember, it's the last 1 minute of a 15-minute interval. So 8:29 a.m., that's the last 1 minute. This officially flipped to a positive ribbon in blue. And now we're looking for pullbacks. These little guys right here, the little circles, this is a new addition, are showing that a trade is building. We're meeting some criteria, and the background algorithm that's doing this is meeting a criteria for a long against this positive 15-minute EMA ribbon. And then an arrow key shows when the actual trade is executed. So this is important because we were able to use a fast EMA ribbon, back test it, and form a long. And then the scalp target is shown right here. Not just for a second there, you saw me hover over this with a tooltip that I'll go over later. That target is where this left-facing triangle is, and it's showing how many ticks of profit we're looking for. In this case, 11 ticks for this trade. So that's the premise of how this thing works. It's extremely simple. You're looking for an EMA ribbon in a direction, in some positive or negative direction, and then you're looking for back tests against that EMA ribbon, and then buying or selling, going long or going short in the direction of the ribbon. It's that simple. Everything else is just background framework on top of that strategy. So the new stop that was added is a basic machine learning stop that learns over time how it should adjust itself based on the current volatility and the past volatility of the instrument that you're trading. So the blue dots here that are shown in the past, this is your long stop, and the current magenta dots, and where it says the short stop, where it is currently, that is the historical short stop. You can turn these off, turn them on. It's all toggleable. I am a big fan of decluttering your chart. I'm a minimalist, and I have all the options available because it's what I would want. I would want to be able to turn some of these things off and turn them on if I feel like it. So the dots are showing the historical stop as the trade progressed. And the current trading style is allowing for a wide stop based on a couple of settings that I'll go over later. So the current stop is shown at 3,447, and a little horizontal line is actually showing that same stop value. So this is all for convenience, so that any trader that's using this, and I trade directly off of the TradingView charts through CQG. This is really handy because I just put my stop right up to it, and that's it. I don't have to do anything else. Currently, there is showing that a short trade is building. We have back tested the ribbon and met all of the criteria that are necessary to form a building trade, and we are going to wait for these bars that I have colored here. I'm using bars in this case. There's two colors. There's a green and a red color that are showing the minor trend direction. When this flips red, that's when a trade is going to be triggered. There are two types of trades, and this is common to all of the Divine Series Divine Series strategies that I have developed in TradingView. There are two types of trades, and it's under the same scheme. A fat arrow is the swing trade, and all of the subsequent trades are double arrows for scalps. The fat arrow designates the very first trade that you take upon the trade direction actually changing. And in this case over here, what I'm looking at, it was a negative trend, meaning that the EMA ribbon was white, and it transferred to a positive ribbon, meaning that the EMA transferred to blue. So the first fat arrow designates the swing trade. And this swing trade, its purpose is to get you long in the new trend and hold it until you get stopped out. Where you get stopped out is where the stop intersects the price, and you'll see a little cross that actually forms, and that cross designates the stopping out position of the current trade. So all of your swing and your scalps, any scalps that are still pending, will all be stopped out at the same location. Any next trade in the current trend, meaning that this EMA ribbon is blue and it's still trending, all of the subsequent trades are this double arrow, which is a scalp. So if I hover over this first trade, you'll see that it says quantity swing and quantity scalp, but the next trades just show the quantity, meaning that it was just a scalp trade. And I'll go over what all of this means later. Both swings and scalps always start out in the building phase. And what is a building phase? A building phase is designated by these little circles for a long or for a short. They're the same thing. They just switch colors to match the stop color. And a building trade means that we've successfully met the criteria to build a long or a short. And now all we are waiting for is for this minor trend direction that's designated by the bar coloring here, either green or red, to switch colors. And the parameters that you have available to you for trading, and I've tried to keep this extremely simple so that you have the least amount of knobs and levers to turn and pull, so that there's not a huge amount of parameters to mess around with for the strategy, which is exactly what you want. Because if you have too many things that you can adjust, it's going to be really hard to find the optimal settings for a specific symbol or a specific time frame. And this execution sensitivity guy, this is what it is. 0 being the bottom, 2 being the top, just in that range. And that's what the execution sensitivity designates. And that's what the bar coloring blue or green, green or red for these bar colors designates. And there's one final coloring, bright green and bright red, that you can change both of these when an actual trade is executed. So the bright green and bright red is when the trade is executed. You can see it. If I change this opacity down to maybe like 40 or something like that for both of these trade directions, you can see the actual bright colored bars stand out. And those are where the trade was actually executed as a market order. With this strategy, there are 4 different trading styles listed under trading style, under strategy. Everything that's listed with strategy actually affects the outcome of the profitability of the strategy. Anything that you set here, and also trade, anything that's trade and strategy will affect the actual outcome of the strategy. Strategy is just more designated towards the specific parameters surrounding the actual trading strategy, and then trade is more like the optimized inputs, the levers and knobs that you need to toggle in order to adjust the sensitivity of the trading strategy. And in the trading style, aggressive, conservative, greedy, volatile, aggressive is the default. Aggressive means that the trading parameters to enter a trade are not as stringent. meaning that you will get more trades, a lot more trades. Conservative is more strict. It takes more parameters to be met for a building phase designated by the little circles, either cyan or magenta, to actually get in a trade. Greedy is a style where you will collect the scalps along the way, close a portion of each scalp. So in this case, like right here, this scalp right here, and this is also a scalp technically, you will collect some profit at the target. And the profit is an exact profit percentage of your original quantity that you got into. Your profit collected will be the percentage of the original execution quantity in order for that specific scalp to be break even. So in this case, I'm looking for 11 ticks of profit, and at the bottom where the current stop was at that time was probably somewhere like, let's see what it actually was. If we look at it really quick, this particular one, the risk reward was something like 0.2 to 1, meaning that I'm risking 5 ticks for every 1 tick of profit. So in that case, you would close 83.3% of your total contracts at the scalp, and you would have remainder 16.7% of your original quantity. And where do we get that number from? That's the percentage you would have to close in order to break even on the trade. If you collected 11 ticks of profit, but your stop was something like 55 ticks at that point, so remember it was 0.2 to 1 for your reward to your risk. You are getting 1 tick of profit for every 5 ticks risked. So in order to break even, you would need to close 83% of that trade. So if you were long, however many contracts, you have to close 83% of those contracts. What that effectively does is if you immediately got that target and the price immediately went down to your stop, that entire trade for that scalp would have been a wash trade, and you would have collected no profit on that. So that's the whole point of the greedy strategy. If the trend keeps going up, then the last bit that you actually held continues to accumulate profit along the way. And this is really handy when you have a sustainable trend for some time. And the market's trending 20% of the time. The rest of the time it's range bound. So if you can catch one of those trends and you're using the greedy version, what's going to happen is you're going to keep some of this trade along the way, so effectively adding to your trade, and you're guaranteed to break even on each one of your scalps. So it's a good way to trade. It's a smart way to trade. And by the time you actually get stopped out, you may have taken 10, 20, 30 scalps, slowly adding to your trade position at ideal locations along the way. So that's the purpose of the greedy strategy. And if you change to greedy, and I wait for this to load, these little bars that are actually loading here, what we'll see over here is quantity break even actually appears. And it says that for this particular trade that I just took on this bar right here, I need to wait for this target, which is at 3429, and I need to close 84% of my original quantity. My original quantity was 3.2 contracts. Obviously, with S&P 500 or anything, you can't do fractional contracts. But if we were using the micros, the MES, instead of taking 3.2 contracts, which is impossible, and the 10th decimal place is chosen on purpose just to give you more clarity on the total number of contracts. It's just to give you a little more precision on the contracts that are required to meet designation, to meet the parameters of the trade type, which I will go, or the quantity type, which I will go into in a second. So in this case, for the greedy strategy, I would long 3.2 contracts or 32 micros. And to break even, I need to close 2.7 contracts or 27 micros, so 84% of the total position. This is because it's calculating the distance between the target and between the stop. The stop can be affected by the sensitivity of the multiplier here. So the stop offset multiplier, which is defaulted at 0.35, if you raise this number, the stop is further behind the price. The target multiplier, if you raise this number, the target is further away from the price. And I found that 1 is pretty good. It's a pretty good number for any time frame. 1 is the default. It's pretty good as far as looking for the volatility of how far should I, what should I set this target multiplier to? And remember, everything is adjusted in real time. So the stop offset is updated in real time based on the current volatility of the trade symbol or the instrument that you're dealing with. So the target multiplier, meaning 1, is going to, the actual absolute target in the number of ticks will change throughout the day depending on the current volatility. So that's why back here you can see that at the beginning of, before the open, the target was 11 ticks. And as the volatility increased through the open after 9:30 a.m. Eastern time for the NYSE Open, the target went into 17 ticks, which is shown as the reward or the number in parentheses under here that you can see. So we're getting another trade forming here, and we're overlapping the previous trade until this actually gets knocked out. If this trade actually formed, this previous text will go away into the more condensed version for convenience. If you want to turn on all of the trade history, you can toggle that to show the entire trade history. Let me find that guy right here. Show historic trades. If you turn this on, every single trade will get the full text that was associated with that trade. So just now, we had the previous text of the previous trade disappear, and it was replaced by the more condensed version that just shows the ticks of the profit, so an 11 ticks of profit total, and the target. The actual old full text of what you have the settings for is shown as the tooltip when you actually hover over the text. And there are more things that you can show as far as the total text output for each trade. And I have some things turned off here, like the risk amount, the risk size, and ticks. The tick size, tick value, point value, all those things are turned off, but you can turn those on to show more. This is just the basic information that's relevant to most traders for each trade that they take. The volatile trading type or trading style, if I turn this on and wait for it to load, this is going to capitalize on a fast shifting market. This trading style allows you to get stopped out very easily, and the trend direction changes according to just the EMA trend direction. So you can take longs and shorts very rapidly depending on the shifting direction throughout the day. So this has been a very good trading style for the last couple of days into late October because there really hasn't been a good trend direction and there are many whipsaws. This trading style capitalizes on whipsaws and is more intended for pure scalp trading only. This is not like the conservative, aggressive, or greedy style where you do have some, more bandwidth on the trade direction. The EMAs can actually shift direction and not knock you out of your trade based on where the stop is. It'll help you hold on to a trade as long as possible. That's good for trending and momentum style trading. This style is specifically for rapidly shifting markets and whipsawed markets where you only want to take scalps. You're not interested in holding anything. You're just going for the scalps only. One of the most important features that was introduced into this strategy is something that I ported over from a video that I produced a long time ago. I'll go over to it really fast here, called Clover Strategy. And this was something where I started quantifying the number of contracts that a trader should use based on the current stop and the risk parameters. So when you look at the quantity type here underneath the trading style, you have 4 different quantity types to use when you're trading. Contract unit is where you would use an exact number of contracts each time for a swing or for a scalp trade. So if I have 2 contracts, maybe I do 1 for the swing and 2 for the scalps to be more safe. You don't want to risk a lot on the swing, you just want to risk a little bit. Let this update. So it just says 2 for the scalp, and if I hover over this guy in the past, this says quantity swing was 1, quantity scalp was just 2. So this is using the same number of contracts every time. If I use VIX multiplier, I won't actually show it here, but the VIX multiplier basically uses a simple algebraic formula to look at what the current VIX price is and looks at my current account equity shown up here. The account equity defaults at $100,000, and that account equity will affect the contract sizing for VIX and for the remainder of these guys, VIX multiplier, percent of equity, and percent risk. It will take into account the equity specified here. In this case, what I have is set for $250,000 US dollars. And it will take into account the current VIX price to offset the quantity that you should actually use for each trade. So what does that mean? The higher that VIX is, the less amount of contracts or lots or whatever that you will actually use. This makes sense because if the volatility is very high, you should start scaling down the number of contracts that you're actually willing to get into because your risk is higher because the price is moving around more. The percent of equity, you can think of this as leverage. This will take the equity in the account designated up here, and it will use a percentage of that equity. So if you wanted to do 3-to-1 leverage, you would plug in 300% here. So if I wanted to do 100% for the swing and 200% for the scalp, what that's actually going to do is it's going to multiply the in this case for S&P 500 futures, the point value is 50. Every point that S&P 500 futures moves, it returns $50. So what that actually means is that one S&P 500 futures contract is controlling 50 shares of SPX. So that's something like $150,000, $160,000 or something like that. I'm just rounding, is what you're actually controlling by one share. So let's just, for simplicity's sake, say that S&P 500 was at 4,000 right now for its current price. Multiplied by 50 because I'm controlling 50 shares. That means that one futures contract is controlling $200,000 of equity. So in order to do 100%, I would actually have to figure out what would it be to control $250,000 of S&P 500, and that would be something like 1.2 contracts to actually get that value. So it's using whatever the point value, whatever a 1-point movement is for the contract that you're looking at to give you that leverage. And in this case, what we're looking at for the current price right now, to get to a scalp of, and I said 200%, I need to take out 2.9 contracts. So I'm willing to risk 200% of the, or the leverage is it's not the risk, it's the leverage that I'm willing to use. I'm willing to leverage 200% of my account. So I'm willing to do, in this case, so 34.29, if I can just calculate this really quick, 3.3429 times 50 is 171,000 times 2, or my equity actually, divided by 250,000. And I just kind of inverse that. So 250,000 divided by 171,000. Let's just say that. So based on my current account equity, $250,000, what I'm really doing by buying or shorting, by going long or short one contract of S&P 500, is I'm only using about 140% of my account equity. That's the leverage. So I have 1.4 to 1 leverage. So that's where if I multiply that by 2, that's where the quantity is coming from to get into 2.9 contracts. The 1.4, like somewhere around 1.45 number times 2 is 2.9. So that's where it's actually coming up with that number. So this is more of a pure leverage play. So people that are on BitMEX exchange or something like that, they're constantly doing things like, I want to use 500% of my account equity. So if Bitcoin is currently at $12,000 and my account is also at $12,000 just for simplicity, and I want to use 500%, that means I'm acting as if my account was at $60,000. So I'm willing to buy $60,000 worth of Bitcoin. So that means my quantity would be 5 Bitcoin because I'm willing to use 500% of my equity, or 5 to 1 leverage is what that's actually doing. So that feature is mostly for people that are coin traders. That's where I see people using that feature the most for the quantity type. The one that I like the most is percent risk. Percent risk will use the current stop and your current equity that you have specified in that equity field to show you the contracts that you should use. And I still have it to 100 and 200. So in this case, I would want to use, let's just say 0.5 again. So I'm willing to risk 0.5% of my account and for the swing trade, and 1% of my account for the scalp trade. So let's see what that produces. So remember that it is showing the tenths place for the quantity just for more clarity, just so that you don't get a rounding error or something like that. But in reality, you would only short or long 4 contracts here. In this case, a short for 4 contracts. Because you can't do 4.2 contracts, you have to round down the quantity. So what I specified was that I want the risk to be 1% of my account. So I'm willing to risk $2,500 of my account on a single trade. And that's because of where the stop is up here near 3442. And the quantity, 4 contracts, if I pull up the risk and I actually say, I want to see what the risk amount is. Let's see what the risk amount and what the risk size is. The risk size is in ticks. The risk amount is in dollars. This trade is already finished, by the way. It's already complete. And you can see that by this little 2 right here and where the 2 is over here. And I'll go into what that actually means in a second. So the risk was 47 ticks, and the reward was only 10 ticks. So the reward risk was, what does that say? 0.21 to 1. That might sound bad, but we're going for quality, not quantity. Well, and some quality. Not big reward risk trades. We're going for accuracy on trades, and the accuracy of this strategy is somewhere above 80%. So if it was a really low accuracy, this would be terrible, because not only is your reward risk really bad, and I say reward risk, not risk reward, because risk reward is something that a lot of people confuse. When you do risk over reward, that would invert this fraction. Your reward risk is actually what you're really looking at, and 0.2 to 1 is not that great. But if you have a high accuracy, it's okay. So the risk is $2,467.50. And remember, I said I wanted to risk 1% of $250,000. So I'm willing to risk $2,500. So in this case, I have a risk that's $2,467, which is right under $2,500. And that's the maximum I can do. I can't go even 1/10 of a decimal place higher. I could not do 4.3 contracts in this case, or I would go over that $2,500 worth of risk. So this is really important because, yeah, TradingView does have built into its trading panel. If you log into whatever trading style you use, and in my case I use AMP futures connected to CQG, their trading thing that you can actually build a ticket to, which I'm not showing, you can build a trade where you actually have a designated risk percent target that you're looking for based on the stop for the trade. They do that for you, but it's tedious when you are trying to rapidly trade. It's much easier if you have something that's showing you right away how much do I actually want to use on this trade because I've already plugged in my equity ahead of time. And TradingView has the gadget that it has. It knows your current account equity based on your trading panel. It'll show you what your current account equity, and this is just your initial capital plus your total profit, not the outstanding equity that you have in locked up trades. It will actually show you this, but it's really nice to have this for each trade on the fly to actually show you what you need to do, because it shows you exactly how many contracts you should be willing to risk. So this is the percent risk trading style, which I really do like. And it's just so important to be able to have something like this, because if you're an active trader, the true test of a good trader is you say to them, how much do you risk per trade? And they say, I am willing to risk 0.5% or 1%, which is kind of high. 1% is kind of high, for me at least, per trade. And that's what people mean by reduce your sizing in order to be a profitable trader. Reduce your risk, and the profits will take care of themselves. That's what that actually means, is that you have your risk per trade so low that it doesn't matter if you get stopped out on 1, 2, 3 trades in a row. You're not going to bust your account because you're using too many contracts at a time. So the trade information that is shown is all of this stuff right here, all the show in the miscellaneous category. Show the quantity, show the reward risk, the risk amount, risk sizes in ticks or pips, depending on if you're on Forex or futures or whatever you're dealing with. Reward amount is always in dollars or whatever currency you're dealing with, whatever currency the account is. The reward size, also in ticks. Tick size, tick value, point value. These are more of just gut checks for if you're dealing with the right information for the ticker that you're dealing with. As discussed earlier, new trades show all of the information unless you specify otherwise by showing all of the historical trades. And in that case, the most recent trades will actually show the trade information for each one of these trades. But I have that as defaulted off just to reduce the clutter. And TradingView will only allow you to do so many trades historically with this kind of information anyway. Something like the last 50 trades or so. So it won't even show all of them in the end. The only thing you'll eventually just see is these little triangles the further back in time you go. But for the most recent 40 to 50 year trades or so, you will see either the full trade information or something like this sideways triangle with the target and the tick amount that's in parentheses, the tick profit amount in parentheses. All of the historical trades, unless if you're not in historical trade mode, all of the historical trades will have a tooltip over the text that you can hover over to see the original text that was there at the time of the trade execution. This is only for the mode where you do not have the historical trade shown, and this is for convenience to have the information about the trade actually there. All scalp trades will have a fill icon when they actually are filled at the target. This strategy can run up to 6 simultaneous scalp trades that are all independent of each other. So in this case of this long back here that we saw, it was the first trade and it has a little 1 above it. And the reason why it was the 1 is because it's the first long in the trade that's outstanding that has not been filled yet. So this is the first trade, and this is the target right where that triangle is pointing left at, is that target, right at 34.38. It was not filled before another trade, another scalp designated by the double arrows here, was presented. And this now has to occupy the second trade slot that was at 34.38.75. The first trade was filled right where this little 1 is. And as soon as that happens, this little guy right here that shows a 1 appears. And if I do bar replay really quick, and I go back in time to this location, and I just walk forward. So right now we've got this most recent trade, and it's showing all the text that I want. And I walk forward a couple of bars. So here's that second trade. And the new trade took over, and this one went to just the historical mode, not showing all the information. It's just the light mode. So when we get that fill, here's that fill. The first trade designated in the 1 slot. So remember, there's 6 simultaneous trades that can be running at the same time. As soon as that happened, this 1 happened, and the tooltip changed to the fact that it was filled. If we walk forward another bar, here's that number 2. And the 2 shows up here on the current trade that it was also filled. So it's reminding you along the way which trades were actually filled or not filled. And if there is not a number above it like this one, that means that you were stopped out before the trade could actually fill. The trade could actually fill. You took a long here, but before the long could fill, you were actually stopped out on this trade. One of the other strategy features for the EMA master strategy, and this is the last part of the strategy area, are 3 separate session windows. And the default is just to have the last 2 blank, meaning that they're not used. And the first is 24/7, meaning that you take every single trade. If you want to isolate 1 or more sessions, you would put in the time. And what I like to use is, let's say I just wanted to, and remember S&P 500 futures are in Central Time. So let's say I wanted to use 2 a.m. Eastern Time. Remember, this is in Central Time, so there's a 1-hour offset. That's just part of the TradingView thing that's going on. There's an hour offset from Eastern Time to Central Time in TradingView. So 0100 actually means 2 a.m. Eastern Time. To 10:30 Eastern Time, so 1 hour after the USA Open. And I wanted to use that as my window. So what I'm capturing is 2 a.m. Eastern Time, remember this is in Central Time, which is 1 hour before London session opens. So I'm capturing just the pre-market London. And then I'm going to 10:30 Eastern Time, which is just 1 hour after the USA session. So I'm basically capturing the pre-market London all the way through London, all the way to this small overlap into the USA session to capture pretty much the majority of the price action overnight. And if you look at a lot of studies that we have in the Daily Edge trading group, we talk about how the majority of gains since the 90s have all been overnight. If all you ever did was long overnight and close your longs at the open of the USA Open, you would have outperformed the S&P 500 by just buying and holding the S&P 500 by something like 600%. Something crazy that you would have actually outperformed the S&P 500 just by buying overnight. So this is something that this captures. And I like this setting for capturing the pre-market London into the USA Open. So the building phase of these trades is still shown here, that we normally would have taken these trades, but we're not taking these trades anymore. These longs are not executed because they do not fit inside of the session window. I can stack more session windows if I want to, and capture maybe if I wanted to capture, say, the Asian Open session, so something like maybe 1800, which is 6 p.m. So I would do 1700, maybe to, let's say, 2000. So this would be 9 p.m. Eastern time. So it would be 6 p.m. to 9 p.m. Eastern time. Remember, there is an hour offset for Central Time for CME futures. So if we wait for this to reload, these three trades right here should be taken. There we go. So I'm capturing now just the pre-market Asian session, and Tokyo, I think currently on Eastern Time, that's not daylight savings time, actually opens at 8 p.m. Eastern Time. So you're capturing 2 hours before the Tokyo session begins and 1 hour into it. And that's what you're doing right here. So this could be a profitable way to trade. And then you just forget about all of the USA session stuff. So these session windows are stacked on top of each other, and I did 3 of them for convenience so that you could do multiple sessions. So if I go back here, I'm going to put 24/7 again, and I'm going to talk about one more feature for this strategy, and that has to deal with all of the features that are ported over from that Clover strategy video that deal with your account currency and the instrument tick pip currency, and how you need to adjust those parameters depending on what instrument you're trading. And if I do S&P 500 off of FXCM, what I'm actually going to show here is one part of this adjustment. So if we look at the S&P 500 contract from FXCM, it says that the pip or the tick location is in the 10th spot, and each 10th movement corresponds to 1 dime of profit, so 1/10 of a dollar. So knowing that, TradingView actually gets this wrong with the return. And I can see all of the information, if I want, about the contract by turning on the last 3 guys here, the point value, tick size, which is just constant information about the instrument that you are trading, or better, hover over the stop icon, and that stuff is always shown. It's showing you the MA time frame, the moving average time frame, which is 15 minutes. This is a 15-minute multi-time frame moving average ribbon. Both of the EMAs are operating as if they were on a 15-minute time frame, but I'm showing them on a 1-minute chart. Shows the trading style, the account equity setting with the correct account currency type, and it's showing that the tick value is $1 and the point value is $10. That is wrong. It takes 50 FXCM S&P 500 contracts to equal 1 E-mini future for S&P 500. And remember, 1 E-mini S&P 500 future controls 50 SPX. If I move up and down by 1 point in ES, I move up and down by $50 in return on the contract. If I'm long or short one contract, I will go up or down $50 depending on the movement of 1 point in S&P 500. So right now it's at 34.35. If it goes up and down by 1 point, S&P 500 futures ES will return $50, or I would lose $50. So this is currently wrong. The point value should be $1. The tick size is correct. TradingView gets it correct. The tick size is 0.1, just like the FXCM contract says. The tick value is wrong. The tick value should also return a dime or $0.1. So what I would do here is I would say tick pip value. I need to manually adjust this instead of saying auto, and I need to put 1/10 here. And when we wait for this to change up here, we can see the adjustment, and this will adjust all of the contract sizing. So now it's correct. Tick pip value is $0.1. Tick size is 0.1. The point value is $1. That makes sense because if S&P 500, this CFD that we're dealing with, this is a CFD from FXCM. If it moves up $1, I make $1. If it moves down $1, I lose $1. But if I'm long or short 50 contracts of SPX 500, I will gain $50 or lose $50, thus satisfying this statement right here, that 50 FXCM S&P 500 contracts equals 1 E-mini S&P 500 future. And that's because I needed to offset the tick pip value to be 1/10. One of the other things that we can look at is if I say go into GBP USD FXCM. Let's see what this does. Now I am dealing with a instrument that is in British pounds. So if you've ever traded CFDs overseas, or you use Owanda or FXCM, you have to take into account whether or not the instrument you're dealing with is in the same currency as your account currency. Since I'm in North America, specifically in the United States, my account currency is United States dollars. But here I am trading something that is in British pounds. So if I don't specify that the tick unit or the tick base currency is in a different currency, I'm going to get the wrong quantities for actually dealing with what I want to actually deal with here. So I need to actually change this to pounds, British pounds. The tick currency is in pounds. My account currency is in US dollars. My account currency is 250,000 US dollars, but I'm trading something that's designated in pounds. You have to do this because you're dealing with United States dollars, but you're trying to trade British pounds. So the Forex exchange rate is changing in real time depending on what you're actually dealing with. So you actually have to adjust what you're dealing with. And this works in the same fashion as if I was dealing with the previous example here, and I go back to, let's say I go back to S&P 500 futures, and I want to do something a little different here. My account currency is still $250,000 of USD. The tick currency is USD. All CME futures are in United States dollars. But let's say I'm in a foreign country and I have a foreign account that's dealing in euros. So if I do this, we should see the contract quantity. Actually, let me zoom in on this over here really quick. So let's just remember what this was. This particular trade right here that I'm pointing at. It said that the quantity swing was 2, quantity scalp was 4. Let's change my account currency to euros. So now this is treating my account as if I had 250,000 euros the current euro exchange rate, if we pull it up, is 1.185. So if we look back at this, I should see the ability to take out more contracts because I'm no longer dealing with a $250,000 account. I'm dealing with a 250,000 euro account. And if we look at what if we translate $250,000 times the current exchange rate times 1.185, what that means is I'm actually really dealing with an account of 296,000 United States dollars when I translate it into euros. So this is treating my account equity as now 250,000 euros. So therefore, this trade that we looked at before that was a swing of 2 contracts and a scalp of 4 contracts now translates into 2.3 and 4.6 because now I'm dealing with a higher account value in United States dollars, and the risk is the same. I'm only willing to risk a certain amount of euros, and in this case, my account number was 250,000 euros again. It's just treating the currencies differently. And the risk on this trade says 2,471 euros, which is a little bit less than 1% of the account equity in euros now. And there are many currencies available. The tick and the account currencies all have the same amount, same availability. All of these currencies are added. And at the bottom, if there is not a symbol for Australian dollar, Canadian dollar, Swiss franc, New Zealand dollar, Swedish krona, and the South African rand, you will not see a symbol for that, but anything else you will see something for. And everything should change on all of the information for the tooltips, on the live trade. It's going to show like the actual currency that you're dealing with for your account currency. So you can do any number of combinations here. Like let's say this was the yen. Let's say the tick currency was the yen. You should see my quantity adjust drastically because of this. It should go like something like 100-fold. So now it's telling me that I can take out 245 contracts for the swing, 491 contracts for the scalp, and that's because the USD JPY currency exchange rate is something like 100 to 1. So you're able to take out 100 times the contracts because now the strategy thinks that one tick of movement is not returning $12.50 in this case for S&P 500. It's returning 0.125, so a little over a dime of return for the contract for each tick of movement. I thought that this was a really great feature. This was all outlined in that original Clover strategy video that I talked about, and I ported it over that entire framework, and I layered it on top of this strategy. So this is great for anybody that's dealing with any international products, any product that you can imagine. You have, if the auto parameters do not work, and again, you can see this just quickly by hovering over the stop at any time to see the tick size, tick value, or point value. These should agree with what you're actually dealing with, and if they don't, then you can adjust the tick. You can adjust the tick unit, and you can adjust the tick value if it's not in agreement. Another feature that was added onto this strategy was the alert framework for the entire trade evolution of this strategy. You can add an alert in TradingView by either right-clicking anything that's the strategy, anything. Could be any output, doesn't matter. Right-click the ribbon, right-click the stop, right-click, anything. Add an alert on MA Ribbon Master, or you can go into the drop-down of all of your current chart studies that are on the chart, go to the little 3 dots, and get the same option. So there's different categories of alerts. Long any, or long scalp or long swing corresponds to long trades when they're actually executed. I recommend doing once per bar, and this will notify you as soon as it happens. If you do once per bar on close, this will assure that you only get the alert when it actually happens. Once per bar might show you, it will trigger every single time the long criteria actually triggers. So you could get like one of these bars over here. This little 1 minute bar probably went up, back down, and now the long wasn't triggered, back up again, long triggered again, back down, it wasn't triggered, because it was going in and out of transitioning from these red bars to the green bars based on the execution sensitivity. So if you only wanted to get a long triggered, when it actually officially is closed and really is triggered, then you want to use once per bar on close. This is what I choose to do because I don't want to get overloaded with alerts. You could have on the way down, you could have had an alert triggered over and over again because momentarily in the bar or the candle, there was a long trigger, but then it shifted back down again by the end of the candle, and it was invalidated. So long any corresponds to both longs and scalps. If you want to only filter between the swing, which is the big fat arrow, the first trade in the new trend, or the scalp, which is all subsequent double arrow trades in the current trend, then you can filter between those. You have to do this per symbol in TradingView, per time frame that you're dealing with. So if I'm at a 1 minute chart on ES here and I add all these alerts that I want, I got to do the same thing for NQ, for NASDAQ futures. I have to add all of those alerts as well. You have to do it for every symbol that you want, for all the alerts that you want. Long building any or scalp swing is the same kind of idea. Long building any is for swing or scalp. That's where these little blue or these little cyan or magenta circles come in. And I also recommend making sure that you do it on once per bar on close so that it is a confirmed, valid, long building signal, so that you don't get them over and over again on the way down in a long building trade or on the way up in a short building trade. They're confirmed signals. For either of these types, you have just for the long, not for the building phase. You'll just get the close price, which is what these are. This little placeholder is in the background. This is just showing. This will get injected with the current close of the ticker when the alert is executed. When you see it on your phone, when you see it as a pop-up, notify on the app, which is the phone app, or send an email or a webhook or whatever you're dealing with. Send an email to SMS, which is another way to get it to your phone. It gets forwarded to if you're on Verizon, you do like vtex.com or something with your phone number, and then it gets forwarded to a special email, and everything from that email gets forwarded to your phone with the text of the alert. The alert will be injected with the value of the current close of the ticker. For the longs or the shorts, you get some additional stuff here. This is the current trade target for the actual trade. So if you got this long, this would be injected with 3438 instead of this plot trade target, whatever. It would just say 3438 here instead. This is what it would look like when it actually happens. Trade stop will be injected with the current value of the trade stop. These are the values and the placeholders that you're going to want to use when you're doing automated trading strategies, whether or not, depending on what platform online that you're using. If you're using something like alertatron.com or tradingconnector.com, you're going to use these values to inject into this trading strategy for another exchange. Like if you're on the BitMEX exchange or Coinbase or Kraken or whatever thing that you're actually using, or if you're doing CFDs or futures on a Wanda or something like that, these are the values that you're using there to inject into your trading strategy with the logic of that exchange. This is the way that you're getting information out of TradingView and into those exchanges. All right, that's pretty much it. And if there's any subsequent videos to follow up on this strategy, I'll be sure to post them. Please message me with any questions that you might have. There's a lot of information on the Daily Edge website, and I will be sure to answer them. Please join us in the Daily Edge trading group. The link is inside of the YouTube information section, daily-edge.com to join us. We have traders from 13 different countries now, and we're trading around the clock, and we've got a really great group of people, and we are trading strategies like this all the time, and they have been working extremely well throughout all of 2020, which is a remarkably volatile year. Okay, thanks a lot for joining. Thank you for your time.